Yes, said that there was a little secret that he needed to share about my new girlfriend, Tina. Well, because it was COVID, my wife was actually dialed into the call to show her support for me. So it was quite a surprise to her when she heard about this new girlfriend, Tina. What he was referring to is there is no alternative. And at that point in time, yields were very, very low in the market, and there was basically no alternative but to own equity assets. And what we're going to talk to you about today is how there is no alternative to there is a real alternative. And Mel is going to talk through a number of the things that we've been thinking about from a fixed income perspective where real yields are. Before we get going, I think we're just going to talk through a bit of background on Lorium, if I can move the slide forward. Not much has changed since we last spoke to you. We are very proud to have maintained our triple BE level 1 rating, and it looks like that will continue into the next year. We run about 54 billion as of this morning. The recent sort of beta run has helped that number, and we have 18 investment professionals in our team. Grown slightly over time, and it's been a very, very stable team. So you would know that the business was started by Murray and Gavin. They look a bit older nowadays than they do in those photos, just over 15 years ago. And we've got a pretty diverse team that is looking across various asset classes. So the people that are very involved in the fixed income side of things is Mel and Shrebi. And quite interestingly, recently joined by Sizzy down at the bottom here. Sizzy is a real Lorium success story. Came through our internship program initially into the operations and finance side of things, expressed an interest in fixed income, and has been absorbed into our power alley of fixed income ladies. And increasingly, we've grown with the quantitative support in our process, adding people with the likes of Jaden joining us. And I think he's partially responsible for the power failures at Eskom, because when he gets going on that computer, it starts to dim the lights. So really, really improved our quantitative processes and analysis with his joining. The two funds that we're going to talk about today are, and I had to change the title of the webinar at the last minute. Mike Titley had proposed the low heartbeat webinar. Like, cheapest, who's ever going to dial into a webinar called the low heartbeat webinar? Because it doesn't sound really exciting, not to me at least. But these are the lower risk funds that we're going to be addressing today: the Lorium Stable Precedent Fund, and then the Lorium BCI Strategic Income Fund. And it's a fairly rough scale that we have here of risk factors, but these are at the lower end of the risk spectrum. The type of funds that you as advisors would be selecting for people that are in the latter stage of their retirement and potentially needing to draw an income out of these funds. We aim for stability in both of these funds. If we look at the South African unit trust that we at Lorium run, over time, we believe we've actually done reasonably well in running these funds, and some of them have a fairly long history. What I always like to focus on this slide is the two right-hand columns, the alpha that we've generated since inception, and you'll see that in the flexible fund, it's 20 basis points, but that's ranked us 4th out of the 24 funds in that category. And similarly, you can cast your eye down the slide. Generally, we've been pretty good at the funds that we have run at Lorium. I'm going to hand over to Mel now to talk through some of that tiara. Did you bring the tiara?
I wish I had bought my tiara. I never turned down the opportunity to wear one. But, it's a home.
I don't wear a tiara too often.
My daughter's too old now. I can't even steal one from her cupboard, unfortunately. Thank you, Rhino, for the introduction. So what I wanted to just initially do was set the scene. And the scene is that bonds are back. And why do we say that? If we have a look at this chart, we've shown here from a global bond yield environment, we've shown two metrics. One is the short-term interest rate in the US, so the Federal Reserve Fund rate, which is the dark line, and then the red line is US 10-year bond yield. And we've taken the history of these two all the way back to the early 2000s. And what we'd like to call out in this particular cycle is that if you look at in this last cycle, where yields started the cycle, they were at extraordinarily low levels. So as we know, US interest rates were at 0%, but bond yields in particular had never been that low. So during the height of the pandemic crisis, bond yields in the US fell as low as 0.5%, 0.5. I mean, that's incredibly low. And then in a very, very short period of time, in fact, less than 18 months, we saw a rise in US interest rates and a really big rise in US bond yields, not just back to where they were before the COVID pandemic, but all the way back to the early 2000s, before the global financial crisis. So very large rise in yields and back to levels we haven't seen for decades.
Oh, can I just interrupt you one second? I'm going to get shouted at by Mike Titley because he wanted to let people know that there is the normal Lorium bottle of wine for the best question that comes through. You're welcome to put the questions in the Q&A, not the chat. Use the Q&A. Mike will moderate those, and I think we'll even let him decide which is the best question that comes through. And Mark Liddy, if you're on, you can't win a game.
Reason to interrupt.
Sorry, I forgot about that.
Don't worry. So what we then wanted to do was just have a look at that period from around about 2014 until where we are now. So we've zoomed into that period of time. And you can see once again, US 10-year bond yields in red at the top. And what really stands out in this chart is that we've graphed bond yields, so 10-year bond yields of really big, important developed market economies. So the Germany 10-year bond yield, UK, Japan, Switzerland. And you can see that those yields were even lower than the extraordinarily low US yields. And at periods of time over this history, actually traded in negative territory, so at yields that were less than 0%, which seems incredible. And at the time, financial market participants were calling it the new normal. And if we look at it like this, we can actually see it really was the abnormal, and now we're back to the old normal. But leaving that aside, why on earth would you buy a bond yield that is giving you a negative yield? You know, you're owning an asset that you pay somebody to own, which just seems crazy, right?
Crazy stuff.
And there were real
Only
reasons
you
for
fixed
that.
income guys understand that.
Only we understand it. I know it's very complicated, but there were real reasons for it. So one of them would have been that you thought that yields would fall even further, so you'd make a capital gain and sell it to someone else at a low level. But the primary reasons were really that inflation was so low that most economies were worried about deflation instead of inflation. And then in addition to that, we had all of these extraordinary stimulative policies that central banks were deploying, flooding the system with liquidity to keep yields at these low levels. So there were reasons for it at the time, but as we've discussed, that's normalized very quickly. And a way to have a look at how quickly that reversed is here we've taken the Bloomberg Global Aggregate Index, which really is just a universe of investment grade global bond yields. You can see how low they were trading in 2020 and 21. And this is the yield on the index. And the yield in the year 22 rose such a sharp level. It rose from about 1.5% roughly to about 4%. So almost a 2.5% rise in yields over a very short period of time. And what that meant for total returns on the index, we've graphed those here. Here you can see calendar year returns. So every line in this chart will show you 1 year of returns from January to December.
So what is that, like 20 years of returns?
Over 20 years, it's the entire history we have of the index. And if you look at 22, which is the red line, it's literally off the chart. We had to expand the scale to be able to click that on. And there were reasons for that. The first one is that when you think about bond yields and the total return calculation of a bond, you start with a yield, and then you have a capital change. So either capital loss or capital gain will give you total return. Now, in this particular cycle, we started with yields so low they didn't even count. So there was nothing to offset the very sharp rise in yield, which was a big capital negative return or capital loss. And there you had, that's minus 16% for the year 2022. So bonds just weren't attractive for us to use in multi-asset portfolios when yields were at such low levels. Now we've seen the big rise and the starting point from a yield perspective and that normalization that's taking place from the new abnormal to the new correct normal, has largely taken place. So we're a lot more excited about bonds globally. What happened to make bond yields rise so much and US interest rates and global market interest rates rise so much over such a short period of time? I mean, we all know the reason for that. Inflation came back. And if I had to think of one word that we used extensively over the COVID period and then the post-pandemic recovery, it would be unprecedented, right? So everything was unprecedented. Unprecedented lockdowns, unprecedented monetary policy, interest rates cut to zero, and a flood of liquidity. Central banks widened their toolboxes beyond what we ever thought they were capable of. Unprecedented fiscal support. During COVID, governments sent checks to every man on the street to spend on whatever they wanted to. I mean, that sounds outlandish, but actually happened. We saw an unprecedented rise in inflation everywhere in the world. You can see here we've shown the US in red, the Eurozone in grey, and the UK in blue, and they all rose to levels that we haven't seen in more than 40 years or longer. US inflation peaked at 9.1% year on year. I mean, that's a very, very lofty, eye-watering level. And we saw an unprecedented rise in interest rates over a very short period of time. So why did inflation rise so significantly?
Yeah, I was just going to say, it was one of the big things was obviously the supply shortages that happened as a result of COVID. And we can't forget.
Exactly. So there were really a couple of rolling shocks that hit the global economy from an inflation perspective. So the pandemic was clearly one of them. So everybody was locked down. So just like the whole world shut down and then was rebooted again. As the world was shut down, everybody was sitting in their houses. They had nothing to do, so they wanted to buy stuff. But the world was broken. So factories were closed. They started and stopped again erratically. Supply chains were fragmented and fragile. So you had this huge demand for goods, people wanting to buy stuff, but the stuff wasn't coming out quickly enough. Too much demand chasing too little supply. So the initial rise was good, 100% right. And then after a period of time, the world reopened, people were let out again. They'd bought enough stuff, and now they wanted to do stuff. So they wanted services, they wanted experiences. And then we saw what we're still living with today is this rise in services inflation. The second shock, though, so it wasn't just the pandemic story. The second shock to hit the global economy was in 2022 in February, when Russia invaded Ukraine. Was a material impact. It did have a material impact on both energy prices, so oil and gas prices, and food prices. Ukraine is a very important food supplier. And that was the second shock that hit global economies. And then the third shock was really China with its hard lockdown, zero COVID policy, also created a lot of noise in the inflation supply chain. So it was really all of those shocks together. But when we think about inflation, just pausing for one brief moment, we talk about inflation as if we all know exactly what we're talking about, but it's useful just every now and then just to delve a little bit deeper into it. And every single country has got different prices that are more important to them than others. And that is how economists measure inflation in a country is they look at a typical basket of consumer goods and services. They call that the CPI basket. So typical things that a consumer will buy in that country, and measuring the change in the price of that basket on a month-to-month basis measures the rate of inflation or the change in the cost of living in that country over time. So that's why we use a basket, but baskets differ from country to country depending on consumer preferences. And a general rule of thumb would be that the lower the GDP per capita of a country, the higher the weighting of food will be in the basket. So here we've shown the US inflation basket, so typical basket of consumer goods and services in the US. You'll see that food is 14%, but if you had to look at some of the Africa countries, food could be as high as 40 to 50% of the basket. So just to give you a feeling of relativity. And then another point to mention is that the basket gets updated over time, right? So as consumer preferences change. So if you think about South Africa, we had our last update in 2022. We added things like gin, think of all the craft gin.
I don't think so,
and things like cappuccino sachets. We took out DVDs and satellite dishes. We took out postage stamps all the way back in 2016. And the UK's just updated their basket. I thought it was quite interesting to see that vinyl records came back into their basket. Who would have thought? Air fryers, which is no surprise. And they took out things like hand sanitizer. So just to give you a feeling of how that basket changes. So when you're looking at a country and the rate of inflation that we anticipate over time in that country, it's very important you think of that basket and how that is likely, those components are likely to change.
We were looking just the other day at a morning meeting at a new function that we found on Bloomberg, and I'm hoping I'm going to be able to switch over to show you what it looks like, if I can. It's not really working to show you, unfortunately, but there is a pretty cool function which hopefully I'll be able to put up later on in the. Let me just see if I can pull it up and show you. There we go. Oh. Yeah, so here it is. Here's the, I mean, maybe you can talk through it, Mel, how you look at this.
Absolutely. So this breaks down, so this is the US inflation basket. Remember we said that food was about 14%, but also has a lot of services and a lot of goods. So if you think about goods in purple, we spoke about that wave of the first shock that hit the global economy was that rise in goods inflation, which was COVID or pandemic related. See how that purple bar increased so significantly over that period of time. Then has started to wane, but services has picked up quite significantly. And a big component of services in the US is housing. That's almost a third of their basket. It's shelter. It's a big component. And housing had a big surge. Can you? That would be so interesting. But housing in the US was interesting. So people came out of the pandemic not wanting, so if you look at shelter, with shelter, which is orange at the bottom, it's very slow moving because rentals get indexed over time. But the reason why rentals surged so much in the US initially is that people didn't want to share houses after COVID. So you came out of COVID, you didn't want a flatmate that you were worried about catching COVID from, or that was playing music while you were doing a Zoom call. People moved away from their parents. You saw this increase in what they call household formation. But at the same time, during COVID, rentals were kept flat. And landlords recovered a lot of that lost rental as the world got back to normal again. So there was another surge there. And then thirdly, people in the US, like they did everywhere, they went to coastal areas and less populated areas just to try it out to see if they could work from there instead of in the big metro centers. So all of those factors result in a surge in inflation, but it has normalized if you look at current rental spot inflation measures. That's going to take some time to work out. So just interesting to see how those components have changed in the US. But inflation is proving to be a little bit sticky above central bank targets, primarily because services inflation is still relatively strong, and that's where the greatest forecast risk rises from. Right, so that's the global picture. Let's now perhaps have a brief chat about South Africa. So we've shown the same chart here. We've taken the 10-year SA 10-year bond yield over time in red, and we've taken South African interest rates, the repo rate in the blue line. And you can see if you look from 2020 to where we are now, we were no different. We also, as central bank, cut interest rates to emergency levels during the COVID period, like everyone did around the world, and then normalized interest rates very quickly in a short period of time thereafter. Our inflation profile was slightly different though. So if we have a look at our basket, so our typical goods and services, you can see food is a larger component. It's the red on the top right-hand side, larger component in the US. And if you take food and non-alcoholic beverages and you add alcoholic beverages and tobacco, those two components together are about a quarter of our basket. And transport, the orange bottom left-hand quadrant, is also very important to us. So what was interesting about our inflation journey in South Africa, and here we've shown inflation in red, CPI, and we've shown the repo rate in gray. If you look at the red line, during the COVID pandemic and recovery, we still had relatively well-behaved inflation. So inflation moved off these very low levels, but our central bank targets inflation between a range of 3 to 6. Those are the two red dotted lines. They de facto target the midpoint of the range. So that's the darker dotted line in the middle. But we still had inflation within the target range, whereas you could see that UK, other developed markets, the US, went to close to 10% and above. We peaked at 7.8%, but the reason why we had that sharp peak was predominantly that second shock that hit the globe. That was when Russia invaded Ukraine. Food prices and oil prices went sky high. Oil prices were less than $20 per barrel during COVID. They
went negative at one point.
They went negative at one point. Once again, really crazy time. They spiked above $130 per barrel in March 2022 after the invasion. So that really impacted us. We just showed you in the basket on the slide before that those are two very big key components of the essay basket. Inflation peaked, is coming back down again in a very bumpy fashion back to the midpoint of the target range. And we do have some upside risks we need to watch carefully, one of them being white maize, El Nino related dry weather conditions in the maize growing regions. Clearly,
and actually also in the neighboring countries as well. I think Zimbabwe, Zambia, 100%. Both have really struggled with drought, which has pushed that maize price.
100% right. So that's fine. So we know that we understand the drivers of near-term inflation, and we understand what we think that the central bank, our Reserve Bank, will do to combat those drivers. What we do know is that our central bank, headed by Lisetta on the slide over here, they are an inflation targeting central bank, as we discussed. They're mandated to keep inflation between 3 to 6%, but they're really targeting 4.5%. And what we have learned from previous cycles is that they will do whatever they need to do to bring inflation back down to that 4.5% range if there's a short-term spike in inflation. And how is this useful for us as fixed income investors? It's enormously useful. So think about what our job is. Our job, particularly within the two funds we're talking about today, is to generate returns that beat inflation for our clients over time. So after inflation returns means we're looking at real returns, and bonds are one of the tools we can use in asset allocation process, right? So how would we know as a fixed income manager whether buying a bond at 9% or at 11% or 12% is likely to beat inflation over that time period? We're buying longer dated bonds. Let's just use a 10-year bond as an example. How do we know that over time that bond yield is going to be higher than inflation? It's a bit like crystal ball gazing, right? Like, what is inflation going to be over the next 10 years? Well, having a committed and a credible central bank makes that crystal ball a lot clearer to us. So we know that our central bank will use every tool they can to bring inflation back down again. That makes our job a lot easier when we're looking at long-dated nominal bonds. And one way of determining whether the central bank is credible or not credible is to have a look at something called inflation expectations. And what those are economic participants, the people who are setting prices in the economy. It's what they think inflation will be in the future, not now, but in the future. And one way to measure that in South Africa is to have a look at this chart. So this shows the Bureau for Economic Research out of Stellenbosch. They run a quarterly survey where they go to those economic participants. They go to financial market analysts. They go to union leaders and people within unions. Those are the ones who set wages over time in South Africa. They go to business participants, so people who set consumer prices over periods of time. And they say, don't tell me what inflation is going to do right now. What do you think it's going to be in the future? So here we've got 2 years out and 5 years out on this chart. This isn't actual inflation. This is inflation expectations. And what is really interesting when you have a look at this is that inflation targeting in South Africa was introduced back in early 2000. You can see inflation expectations are relatively erratic over that initial period of time. And then you can see how nicely they leveled out at the upper end of the target range for a long period, regardless of what spot inflation was doing. Inflation expectations were very well anchored. Reserve Bank said, great, job well done. We've anchored our inflation expectations, but at the upper end of the target range doesn't make us so happy. We want it to be at the midpoint of the target range. That 3 to 6% range is really wide. And so from about 2017, they started to deploy tools to bring inflation expectations down even lower. So they could have flexibility. They don't want inflation anchored at 6%. They want it at 4.5%. And they did such a good job. They achieved that so beautifully. If you look at the circle on the right, very well anchored at the midpoint of the range. Then we had this huge surge in global inflation and our own inflation surge. And remember we said CPI in South Africa peaked at 8%, 7.8% year on year. Inflation expectations looking forward did move a little bit higher, but still remained well anchored within the target range. So that gives us a lot of forecasting ability when we're looking at inflation in the future, regardless of what's happening with short-term inflation. We've got a very good anchor for what likely inflation will be over time.
So I mean, you could argue that Lisetta and his team probably did a better job through the crisis than a lot of other central banks.
So where they did a better job for sure, because inflation expectations were relatively well anchored in the other economies as well. So that was important. But what they did do was that They moved quite early in the cycles. They moved ahead of the Fed and the other developed market banks. And they never took their foot off that pedal. So they never relaxed their stance. They are still talking very hawkishly because they know they want to keep expectations anchored at these lower levels. So, it's a great gift we have as SA investors that we have this very credible, very committed central bank. Absolutely right. So how does this help us when we're looking at bond yields? Here we've taken the 10-year bond yield in South Africa. It's obviously risen in line with all sorts of other countries as yields have moved higher. How do we know what that real yield might be over time? If we take a 10-year bond yield today, trading around about 12%, and we strip out what we think inflation will be over this period of time, over the next 10 years, and here we've used 5%. So we know the central bank's targeting 4.5%. Let's just give it a little bit of slippage and use 5%. You take the 12 minus inflation of 5, and that gives you an after-inflation yield or a real yield of 7%, which is really high. And there is a real alternative if you need to include some bond exposure in your portfolios, and particularly your multi-asset portfolios. So very briefly, and then I'll hand over
just talking to those multi-asset portfolios. Now I'll get into a little bit with our stable fund, but across all of our multi-asset portfolios, whether it's our high equity balance fund, our medium equity balance fund, or our stable fund, which is the low equity balance fund, we're running the highest exposure that we've ever had to fixed income instruments in South Africa because of that real yield. I mean, to put it another way, if you have an objective of a fund of beating inflation by 5%, in theory, if your chart is right and if your 5% inflation assumption seems reasonable to me, you're getting 7%. So you can basically, if you really wanted to just take the whole fund and put it into South African government bonds, the 10-year or thereabouts, you could probably achieve that objective. So it's one of the reasons that we've been running very high exposure on a risk-adjusted basis to these fixed income instruments across all of the multi-asset class funds that we run.
So just to explain very briefly how we've done that within the fund. So we're starting off with the strategic income fund. So this is the lowest of the low heartbeat funds that you were showing earlier in the presentation. But
we're going to get away from this low heartbeat stuff.
Yeah, exactly. It's still really interesting, really exciting. And you can see how we've represented, we have guardrails, very strict guardrails in this portfolio that we don't want to take too much bond risk at any point in time. This is an income fund, it's a multi-asset income fund. We can stretch our legs a little bit, but we're very aware of capital volatility over short periods of time. So we need to set strong guardrails around that. So we do limit the amount of bond exposure or duration exposure that we have in this portfolio. So if you look at the arrow on the right, you can see what our fund duration is at the moment, 1.7 years. The highest we can go is 2 years in this portfolio. So we're up against that upper end. But if you were to invest 100% in a bond fund with an all-B duration, you would be at the upper end of that arrow, 5.5 years instead of the 1.7 years. So we're not as risky as a bond fund. We're still an income fund, but we are utilizing the opportunities available in the bond market within our guidelines or within our risk appetite ranges. And we pick it up in two ways. We pick it up in the fixed income, more than a year, which is 37% of the portfolio. Still relatively short-dated, very low duration, but has allowed us to take advantage of opportunities across the short end of the curve. And then our SA government bond exposure, which is the grey pie chart on the left, we're at 27%, which is quite high relative to the history of the fund, but still very, very well within those conservative duration guidelines. What one of our main aspirations is when we construct the portfolio is to limit the risk of capital volatility or negative returns over a quarter at a time in the portfolio. And you can see that we have had very few negative months, never mind negative quarters, very, very few negative months. 93% of our track record has been positive, even though we've had this period recently, as we were talking about earlier, where global yields had these incredible eye-watering negative returns. We've generated consistently very strong returns from.
And then you've run the fund right since inception.
Since inception, that's right. So that's our track record going back in time. 100% right.
Well, Mel talked about stretching the legs a little bit, and our stable fund is a kind of an extension of the income fund to a certain extent, but it gives us a few other tools to use to just increase returns slightly over and above the what one is able to do in the income fund. I kind of think of this fund in some ways as my mother-in-law's fund. You know, it's something that I wouldn't have a problem putting my elderly mother-in-law into, because what we try and do is we try and achieve stability with the fund, but yet generate a good real return in that late stage of your retirement.
Greater potential for capital gains.
Exactly, exactly. And Mel and I run this fund together. I'm a little bit more aggressive than Mel on some matters, and Mel is very much my anchor or handbrake on some of the things. So you know, if there's stability, it's Mel that's helped drive the stability over time. So the objective of the fund is CPI +3, and we've kind of achieved that over time. It's done what it says on the tin, and actually through some fairly volatile times. You know, I mean, you know, we've come through COVID. It had a tough time in COVID, but we've done reasonably well, we think, within this fund in terms of protecting capital and delivering on the inflation objective. And you'll see here, this is since we started the fund in December 2018. The red line is the stable fund. The black line is CPI. So we have achieved that objective of beating that CPI +3, and then also importantly have beaten the other guys in the category over time. Just thought I'd share some of the things that we've been thinking about and some of the views that we've had, and also pointing out how wrong markets can be. So what I'm plotting here is the Fed fund rate. So you know, it's not a coincidence that we started with a picture of Table Mountain when we started the presentation, because Table Mountain has been one of the things that has actually become part of financial vernacular, so to speak.
Across the world,
not just in South Africa, that the profile of the Fed funds rate looks more like Table Mountain than the Sugarloaf or anything else. So Fed has kept the Fed funds rate on the sort of 5.5 level for quite some time now. What happens is that you're able to plot by using various market mechanisms where the market is pricing in. You use swap curves, you use all sorts of things, and there's a function on Bloomberg that you can pull up which gives an implied market pricing of where that rate is going to go to. And if we can go back to January of 23, but I've decided just to go back to the beginning of this year. At the beginning of this year, this dotted line shows you that the market was expecting that you were going to start to see significant cuts come through. Kind of would have happened already by now, because you can see that by
they're priced by March.
Yeah, they were going to be cutting by March. Now, obviously, we know that that hasn't happened. We actually held a view within Laurium that was not going to happen, that the market was incorrect, and that the Fed was going to keep rates higher for longer. We've been proved right, because February, fairly similar to what it looked like in January. March, a few things happened. There was an inflation print, there was a jobless print that came through, and all of a sudden the market started to adjust for the fact that the Fed's not going to have 4 cuts this year. In fact, they might only have 3 or 2. And then if you take it to where we are at the moment, this is, as at present day, we're only pricing in basically one cut by the end of the year. So it's often said that the market gets things right, but in this instance, the market has actually been pretty inefficient at pricing in where global interest rates are going to go. So that real yield that Mel has been talking about over time has actually been maintained for longer than the market itself was pricing in. If we look at the S&P, because we're able to own equities within our stable fund, and I'll show you how we think about them and the weightings that we have in the fund of the equities. One of the key markets in the world is the S&P. This is the 1-year forward PE multiple of the S&P. So you guys have seen this often. It is trading, we think, reasonably expensive at around about 21 times forward. everyone on the call would have heard about the Magnificent Seven and the impact that they've had on the PE. In fact, because their earnings has been so high, they actually haven't had that big an impact on the PE, because remember, it's price divided by earnings to give you your PE multiple. But at 21 times, we think that is looking reasonably full. So across our multi-asset suite of funds, we've actually been underweight offshore equities purely from a valuation perspective. And as recently as yesterday, I was looking at this chart because we've had so far roughly half of the S&P 500 have reported their results. So let me just try and explain what's going on in this chart. These are the various quarters. So you see on the left-hand side, quarter 1 of 23, quarter 2 of 23. The blue bar is the earnings growth that has been generated, the dark blue bars, and then the red bar is the sales growth. And so you can build up over time how things have grown, how earnings have grown and sales have grown. So you'll see if you read the current quarter, and as I say, we're kind of halfway through, about 250 of the 500 have reported, and you've got earnings growth running at around about 3.5%, and sales growth just a little bit more than that. But then if we look at what the market is forecasting, and remember these forecasts going one year out, make up the earnings of the previous chart. The price earnings ratio of the previous chart is what is factored in these forecasts. So if you see, and in the extreme example, far right-hand side of this chart, you've got the market expecting sales to grow by just over 5%, but yet earnings to grow by 15%. Now, there are only a few ways that you can do this. You can widen your margin. Our margins have really widened quite significantly. So we worry about the ability to generate 15% earnings growth or 5% sales growth a year out. And that's what gives us further cause for concern around the stretched valuation, because you've got price over an elevated earnings level. And it's just interesting to see the evolution over time. You could say, well, okay, you've got 15% growth off a low base in the same quarter of 23, but it still is, we think, quite punchy in the US. So we've maintained an underweight position in offshore equity markets in our funds. If you look at and a lot of you who've joined these webinars previously would have seen the evolution of this chart over time. What I've done here is plot a very similar one-year forward PE multiple of various markets around the world. The top one is MSCI USA, very similar, kind of 20-ish, 21 times, very similar to the S&P. The bottom one, the red line, is MSCI South Africa, trading at a very low sort of 9 times forward multiple. And it's just this amazing dislocation that has happened in valuation. If you cast your eyes to the middle of the chart, back to sort of March of 2018, you will see that the South African market and the US market basically traded at parity with each other. And there's just been this huge disparity that has taken place between the two markets. A number of the issues are our own goals from ourselves. We're all painfully aware of load shedding, etc. But we just think that the disparity of over 10 turns of relative valuation of US to South Africa is reasonably large. And if you look at another way, and this is a proprietary index that we create on Bloomberg of just the businesses in South Africa that dance to the heartbeat of what's going on in South Africa. So it's predominantly banks, retailers, some of the industrials. We strip out all the international companies. We are trading at the moment at effectively 2 standard deviations cheap relative to the long-term average. And as a stock picking equity house, we are starting to find more and more opportunities in domestic South Africa. When obviously there are concerns, and we can go through it in Q&A as to what will happen with the elections, etc. And a lot of those fears are not only priced into the equity market, but have also been priced into the bond market. So we've been finding some reasonably good opportunities in this space. The way we run our multi-asset class funds is we run them to what we refer to as base case. That's a sort of colloquial term that we use internally. I think others might call it strategic asset allocation. For us, base case is what you as the investor should expect that the long-term asset allocation of this fund will be through the cycle over time. It also enables us to express a view within these multi-asset class funds as to whether we are bullish or bearish the particular asset class. We have what we refer to as an asset allocation process. I'd hate to call it an asset allocation committee, because if you call it a committee, it feels like you're working in a government department, and it also feels like you're only going to make a decision after you've had a committee meeting. Mel, myself, Rob, Murray, Gavin, and a number of the other members of the team chat virtually every day about our asset allocation. We do have a quarterly meeting where we sit down, we present some views, we share I accumulate some anonymous views into a centralized spreadsheet to try and remove any groupthink that might come in. And importantly, at that meeting, we try and ensure that the portfolios that we're managing mirror the view that we have in the market. So if we bullish bonds like we are at the moment, you should expect that all of our multi-asset class funds are overweight bonds, and that is the case at the moment. So if we look at how the stable fund is positioned at the moment, we are sitting in terms of equity. We're slightly underweight equity relative to our base case in equity of 35%. Reason being, we are concerned about valuations in offshore equity markets, so we underweight the foreign equity component. We kind of at-weightish the South African component. Property, we've been underweight for some time. Mel, for his sins, covers property as one of our property team. The property team. We have a number of people in our team with interest in property. And then you'll see in the fixed income space, because of those real yields that Mel spoke about so eloquently, we are sitting overweight the fixed income component of this fund. And we always run a reasonable amount of cash within the fund, and cash is actually offshore generating reasonable returns, again, because the real yield that is there. So you'll see the top 10 holdings on the right-hand side of the screen. You'll see a number of South African government bonds, primarily in what we think of as the belly of the curve, where we see the biggest value in the bond market at the moment.
And I think, sorry, just on that note about US cash, for so long, this new normal period post-GFC, holding offshore cash was such a grudge purchase. It was there for diversification and for risk management, but you didn't earn anything on it. So it was a very frustrating part of the portfolio to allocate. Now 5% US cash, it won't last forever, but it certainly is. It's an asset class in its own right, and it pays you, which is great.
The other asset class that we've invested in, and Mel is a co-portfolio manager along with Paul Robinson, is on our Africa Bond Fund, which is a 2.5% position in this fund. It's 4.5% in our high equity fund. Mel, maybe just a couple of words on Africa Bond.
So that is predominantly over 95% invested in Eurobonds. So it's Eurobonds which are non-local currency. It's dollar or euro denominated bonds issued by sovereigns. So sovereigns across Africa. We've got a very deep Africa team who's got decades of experience on the continent. And this fund was started a couple of years ago to take advantage of that, but a much lower risk type of representation of Africa. So it's Africa Light, I think of it in my mind. And it's government bonds earning really attractive real yields. And we compare it essentially to offshore, so it's not part of our offshore allocation, and it replaces high yield. So high yield offshore spreads are very, very tight. We've seen some real opportunities within the African space for similar type of risk, but much better returns, and that's been one of our best performers over the past period of time.
It's been a great contributor to all of the multi-asset class funds over the last year or so. I think that brings me to the end of the formal presentation. And sorry, I know there've been some Q&A that have come through, and we've just been rambling on. But I think we've got 15 minutes to go through the Q&A. I don't know if when I pull it up like that, if everyone can see it, but we'll go through the questions in order. I see Mark Liddy has outdone himself again. He's always our most our anchor tenant. But Lizette asked the question, if people can't see it, what is the opinion of foreign investors in South Africa? Anywhere on the radar, or was all marketing? Lizette, I'm going to answer on the equity side of things and ask Mel to try and answer on the, both of us try and answer, because it's always difficult to speak for other investors. Interestingly, with my background as a stockbroker, investment banker, I still keep quite a lot of contact with the clients that I used to service in London. And I actually had breakfast with one of the big, I guess, people we compete with at the moment when she was out here literally a couple of weeks ago. And I said to her, what are you doing out here? You guys, South Africa is a very small part of the MSCI Emerging Market Index. You guys are very big investors. What's the, what even brings you here? And the issue, and I think that the crux of this is that most of the foreign investors that are benchmarking themselves to MSCI emerging markets are underweight South Africa. They recognize that there is a potential for a rally that could take place post elections, and there's a potential for a rally that just could be driven by some of the things that are going badly going less badly. Let's just think of things like load shedding, like Transnet. I mean, I didn't think I'd be sitting here, unless I'm as cynical as anyone else, that we've got elections coming up. I didn't think I'd be sitting here saying we've had 30 days without load shedding. I mean, it's a long time since that last happened. And that is a positive impulse for the South African economy. So foreign investors do still care. It is a investment destination that they can make very good money in very quickly, and are cognizant of that. We do see them coming through through and looking at South African equities. I don't know what you're seeing on the bond side.
So on the bond side, it's very clear ahead of elections that foreigners aren't going to take a strong view. Some will, and we see some global houses recommending overweight SA bonds, but the price action tells me otherwise, that investors are sitting on the fence. Emerging market investors they've been burnt by elections in other emerging markets, and so they really don't want to take strong views ahead of elections. There are two things that could change. So one is that our elections, we could get through relatively intact, and with either stable policies going forward or some sort of improvement, which is that's our base case, actually, if we look through all the different probabilities. That would bring foreigners back in. But more importantly, we need to see emerging market bonds as an asset class come back into favor. So we often forget South Africa is actually just a component of an EM class on the bond side. And with Fed rates moving up, it was a very bond unfriendly environment. We then had a brief glimmer of hope that things could be stabilizing. Then Table Mountain looked like it was going to be flatter for longer, and we've seen it's still a relatively nervous global backdrop for bonds. When things will change is when we start to see the first interest rates cuts coming through, which will happen. It feels like it's never going to happen, but it will happen. And then it's a much bigger tailwind for global bonds and for emerging markets in particular, and we will absolutely benefit from that in South Africa. So there's really SA specific and then global factors that we need to consider there. But foreigners, we're very much on the radar screen. We see foreigners doing investor trips here all the time. We often have calls which are held by foreign banks about South African bonds. So we certainly haven't fallen off the radar by any stretch of the imagination.
Do you want to answer Mark's two questions together?
Of course. So QE, yes, this is I could give you a very long and complicated answer to both of these, actually, which I won't. I'll save you from that. But essentially, so QE, quantitative easing, where we spoke about extraordinary, unprecedented monetary policy, central banks cutting interest rates to zero and expanding their toolboxes. What did that look like? They basically did all sorts of things that they hadn't done before post-GFC. So they used their own balance sheets to buy bonds. They flattened the curve. They had Operation Twist. They had all sorts of things that they did in the US to bring yields lower. Clearly, that all unwound after COVID. Inflation shot up. They started to increase interest rates. We then moved from quantitative easing, which was extraordinary support to the market, to quantitative tightening, where they were rolling back on that support. We're now, interestingly, at a phase where interest rates have either peaked they probably peaked at these levels, They just might be held for longer. But that quantitative easing, which then became tightening, is now going to become almost easing again, just by its natural evolution. So less of an issue, but we do think very deeply about how that impacts the shape of the yield curve and things like that. But yields at these levels probably elevated, but we would not anticipate them to go back, global yields to go back to where they were in that new normal period. Sorry, the other question was just about European inflation. So just a brief thought away on Euro. So Europe is obviously quite a well-advanced developed market economy. So you'd expect a similar weighting to the US and many of its goods services mix, as opposed to clearly what we'd have in Africa and emerging markets. But the gas element is one that Europe has, where they import a lot of their gas, and we're heavily impacted when Russia invaded Ukraine and cut off their gas supplies. Gas was a huge issue in spiking Eurozone inflation across the entire region, which the US didn't have. The US obviously has oil and gasoline prices is important for them, but over time, the US has become less of an oil importer and actually oil resilient and an exporter at times. So those are very different dynamics from an energy component between Europe and the US. Were there other questions?
Mark was asking about unemployment in South Africa.
Air fryer question.
So what else?
My air fryer is in storage at the moment, so I'm not on the ground market research to guide you. But the UK, if you chat to any Brit, everyone has an air fryer, or 2 or 3 or 4. So it didn't surprise me that air fryers went into the basket.
And then Mark was just asking about SA unemployment related to crime, etc.
Yes. I didn't see that, sorry.
The bottom one there, SA unemployment out of cold, SA does not consider this, whereas you look at the US, the unemployment, I guess it's the interplay between keeping inflation in check and unemployment.
Yeah. I saw Alicia had a great question there, which we haven't touched on.
Yeah.
So we'll keep on almost talking around it, but let's maybe address the front and center.
Do you want me to show that slide? That I thought it might come up. So we do have a slide that we've been using in some other presentations. Let me just get rid of this. And
so maybe while you're bringing that up, when we concede 100% upfront that there's a lot of uncertainty and that expectations will change over time as we get closer to the election. So taking all of that as a disclaimer up front, what we have done, because it's obviously elections, being South Africans, it can be a very emotional touchstone for us. But we are investment professionals and we have to look through the noise and think through likely outcomes as well as the more unlikely outcomes and how they could impact our portfolio. So to do that, we've put together a probability tree. The probabilities might change as we get closer to elections. We're a month away now, so it would probably be marginal. And this really encapsulates our thinking. And every time we are having an election discussion internally, we bring this up as our, like our lodestone, just to keep our conversation rational and let's think through the different probabilities. I'll do this very briefly, but very happy to chat through this offline with anyone on the call, and Alicia, yourself as well. I must have listened to 18 political calls in the past month, and I've got reams and reams and reams of notes. So I think we're very educated in our thinking, but elections obviously can be very uncertain outcomes. So thinking through the different probabilities, it does revolve around the ANC. So whether the ANC gets somewhere 48%, 47%, I know the polls aren't indicating that, but all of the experts that we speak to do lay out the problems with the polls and how the methodology isn't as strong as it could be or should be, and we have to make adjustments for all of that. So it still is a possibility that the ANC could get 48%, thereabouts 47%, and be able to do a coalition with a smaller party, then business as usual. So then we carry on as we have in the past. We've given that a 15% probability. Our central scenario is ANC somewhere between 43 and 47. I know the polls are showing lower, but if you adjust it for turnout ratios, it moves the ANC higher. And we know the ANC has got what they call a squeeze in the last couple of weeks. As it gets to the election date, they mobilize on the ground. They're the only ones to have a presence in every single voting district across the whole country. And that there's been an effect in the past. We've tempered that effect a little bit. based on our expectations, and we think, yeah, they could get 43 to 47%. And then they could have a coalition with smaller parties and an IFP. I won't go into a lot of details, we haven't got much time, but there are certainly many reasons to think why the IFP and the ANC could enter into a coalition to keep stability and in KZN, just to keep stability and lack of instability from the MK and all the threats and concerns that presents within the region, within the province itself. That's our base case. On the right-hand side is clearly the worrying case. So ANC falls to 43% or below. We've given that a 30% probability just to indicate that it is something we think quite deeply about. But then you don't immediately go to what we think of as the really market-unfriendly scenario of an ANC-EFF coalition. Obviously, it's on the table. It has to be on the table. But there are many other ways that the ANC could still govern, whether through a coalition that's formal or informal, or other ways that you can form a government post-elections that doesn't necessarily need to include the EFF outright or the MK, which is probably the lowest probability of all, for many different reasons. ANC could enter then into a coalition with the DA, formal or informal. It could be a confidence and support type of agreement where the DA gets to appoint the speaker, so they get the parliamentary oversight, and then maybe one or two cabinet posts, but they govern informally and they say we won't have a motion of no confidence and we'll support the budget, but everything else we need to discuss. So there are lots of ways to skin the cat in between that. Why the DA? Well, is there aren't they enemies? Why would they form together? We do know that the centrists within the ANC would actually prefer DA over EFF. DA, you're doing a deal with the party, you're not doing it with an individual. It's kind of the adults in the room relative to a very unstable, unpredictable coalition if it were to go with EFF. And if the DA does get relatively high support, 20% or above 20%, ANC and DA together are representing the wishes of the voters. So there are many, many reasons why they would consider the DA loosely or more formally, or some sort of government of national unity where you actually have a couple of parties which are represented in your cabinet and you can govern. A minority ANC can pull together that coalition and govern through that. So there's so many permutations.
Well, I guess the important thing to point out here is that you actually got to do probability of probabilities. I think Mike's just running a spot quiz if you want to answer it in the last 2 minutes as to what people think, so we can share the details of that. But the point is here that, you know, a really market unfriendly scenario is 30% multiplied by the 25% probability. So we're sort of 7-8% around there that things are really bad, which would be negative for the market. Mm-hmm. And in the funds that we're talking about today, actually in both funds, we have bought some out of the money call options to protect the funds, call options on the US dollar to protect the funds in this scenario, which we see as a low probability but high impact scenario. So we bought cheap protection to afford that. If that doesn't happen, if the worst case scenario doesn't happen, we think as a house that it is going to be positive for both the South African equity market and the South African bond market, because both of them are pricing in a bit of negativity.
Yes, so that's a very key point, is that we're not dismissing the low probability, high impact. We're actually thinking very carefully through how to protect the portfolios against that. And every portfolio will have a different mix or protection strategy that we can use. In the income fund, we've bought dollar calls over that period, which we did in the stable fund as well. And we've also been careful not to extend risk too extensively over this period. So bond yields are reflecting fragility, nervousness ahead of the elections. We're not significantly increasing duration into that. We're happy with our levels. We don't want to put our heads above even further, just in case we do see that type of outcome. We're thinking very risk measured through the portfolio construction. Both stable and income are thinking that way.
There are a couple of other questions, but I'm mindful of time. I think Stefano asked when we thought rate cuts would eventually take place. Very dependent on what happens with the Fed. We don't think that the Reserve Bank in South Africa is going to go ahead of the Fed, so probably fourth quarter at best. And then there was another question from Mark on the 493, on the S&P of the 493. PE for the S&P 493. Mark, I've got a chart. I've created an index on that. I will send it through to you. But it is about one standard deviation expensive relative to history. Mike is just sharing the answer to that poll. I think you can see it on the screen, but I'll just read it out. So ANC IFP 50% chance, ANC DA 25, ANC EFF 14, and MPC opposition coalition majority 11%. I think we should leave it there. I hope you've enjoyed talking to us. Mike, I don't know if you can jump on and tell us who's won the bottle of wine. Or if you
Thanks
can
for
get
that opportunity, Rainer. I think I'm going to go with Alicia, considering how she sparked quite a lot of debate around the elections and how you guys are going to position and what are you expecting.
I concur with that. Alicia, we'll make contact with you. Guys, thanks again for joining us. I hope you found some interest in what we had to say, and join us again when we do the next boardroom talk. Thanks a lot.